In this video, I'm going to talk about journal entries and just the basics of how to do a journal entry. So to start with, what is a general journal? A general journal is the listing of all transactions or events at a company that impact the accounting equation. I like to think of it as like a journal or a diary before a company. So when we're looking at the general journal, some characteristics that you'll see is that all of the events or transactions are listed in chronological order. That means they're ordered by date. And then when you're looking at the journal, you can see all the accounts that are impacted in that certain event or transaction. What it does is it allows you to see the whole effect of that transaction. Journal entries are what we use to record the information into the general journal. There's a few rules that we have to follow when we're recording journal entries. The first one is that at least 2 accounts are always impacted. We're always looking for at least 2 areas that we need to adjust in our journals. The second is that our total debits must always equal our total credits. Both of these 2 rules help us make sure that we're always keeping our accounting equation in balance. Our third rule is that we do a separate journal entry for each transaction or event at our company. We don't mix and match journal entries. Now, before we get into doing some journal entries, let's review our rules for the debits and credits. So again, if we start with our basic accounting equation of assets equals liabilities plus stockholders' equity, and we remember that debit means left and credit means right, then we know that our assets have a debit normal balance because they're on the left side of our equation, and our liabilities and stockholders' equity have credit normal balances because they're on the right side of our equation. But remember, we don't directly impact stockholders' equity. Instead, stockholders' equity is broken into retained earnings and common stock. And we further break our retained earnings into net income, which increases retained earnings, and dividends, which decrease retained earnings. And we can further break our net income into revenues, which increases net income, which therefore increases stockholders' equity, and expenses, which decrease net income, and therefore decrease stockholders' equity. And so now we can go back and look at our accounts that impact our stockholders' equity, and since common stock increases stockholders' equity, and it's on our right side, it's a credit normal balance. And since dividends decrease stockholders' equity, even though it's on my right side, it acts the opposite, so it's a debit normal balance. Same thing, our revenues increase stockholders' equity, so they're a credit normal balance on our right side, and expenses decrease the right side of our equation, so they're an opposite, they're a debit normal balance. Remember, the normal balance is what you will give to an account to increase that balance. So to increase an asset, you would debit it, but to increase the liability, you would credit it. Now let's look at some journal entries and do some practice. The owner invests $4,000 cash into the company in exchange for common stock. So in our situation, our first rule is we always need to look for our 2 accounts. So here we have stock being created and we have cash that's going into the company. So our cash is an asset and our value of that asset is increasing because the cash is going into the company. And our common stock is a common stock account, which is part of our equity. And the stock is increasing because it's creating equity in that company. And so if we go back to our rules, to increase an asset is a debit, and to increase common stock is a credit. Now we can create our journal entry, which is a debit to cash for $4,000 and a credit to common stock for $4,000. And we're following our rules. We have a debit and we have a credit, and our total dollar value of $4,000 is equal between the debits and credits. Let's look at this one. Sam buys 1 year of insurance for $800. So our 2 accounts that we're looking for, we're buying some insurance and we're going to use cash to buy that insurance. Now when we're buying a 1-year insurance policy, we are buying it for the whole year, but we're not using it all at once. So that's why we call it prepaid insurance, because we're buying it for an entire year. And prepaid insurance is an asset, and cash is also an asset. But in this case, my asset of prepaid insurance is increasing, while my asset of cash is decreasing. So to translate that into debits and credits, we would debit our prepaid insurance, but to decrease an asset is the opposite of the normal balance, which is a credit, so we would credit the cash. So even though both of these are assets, we're still following our rules because they cancel each other out. We're exchanging a cash asset for a prepaid insurance asset. And so our journal entry would be a debit to prepaid insurance for $800 and a credit to cash for $800. Next we have advertising costs, paid in cash of $1,000. So first we need to identify our two accounts. Advertising is a cost of running our business, so that's an expense, so that's advertising expense. And then it says we paid in cash, so we know that we're going to be impacting our cash account. Our advertising expense is an expense account. My expenses are increasing because my costs of doing business are increasing. My cash we know is an asset, and we're using cash, so that's decreasing. According to our rules of debits and credits, to increase an expense, you give it a debit. To decrease an asset, you give it a credit. And then we can build our journal entry. Debit advertising expense for $1,000, credit cash for $1,000. Next, supplies acquired on account $2,000. So our first account is supplies, which is an asset. They're a resource to us. They're something we're going to use in our business. And then it says on account. Whenever you see this on account, that tells you that cash was not used. Instead, we owe that money because we're the purchaser, so it's accounts payable. Accounts payable is a liability, and our liability is increasing because we owe more money. Our liabilities increase as we owe money. They decrease as we pay it off. So we have our asset of supplies increasing, that's a debit, and we have our liability of accounts payable also increasing, which is a credit. So our journal entry is supplies, debit for $2,000, credit to accounts payable for $2,000. Now it says cash paid to creditors for amounts owed. So here what we're doing is we're using some cash to pay off amounts that we had owed, which is accounts payable. So our asset of cash is decreasing, and our liability of accounts payable is also decreasing because now we owe less money. So to decrease our asset is a credit, to decrease our liability is a debit. Remember, to decrease an account, you do the opposite of its normal balance. And our journal entry then is debit to accounts payable for $500, credit to cash for $500. And you can see here that our debits are always on the top and our credits are always on the bottom. That's standard notation for writing journal entries in accounting. Services provided to customers who paid $750. So now we've provided some services to our customers. We're running our business. That's a revenue, and we call it service revenue when we're providing services. And then it says the customer's paid, so that's cash. And so our revenue here is increasing because we're providing services, and they paid us, which means our asset of cash is also increasing. And according to our rules, to increase a revenue is a credit, and to increase an asset is a debit. Our journal entry then is a debit to cash for $750 and a credit to service revenue for $750. So again, in this case, both items are increasing, but we still end up with a debit and credit because we're following the rules of our accounting equation, and our debits on the left and credits on the right. Next, services provided to customers who have not yet paid $1,500. So now we've provided the service, and we've provided that service, we get to count it as revenue, even though they haven't paid us yet. When somebody owes us money, that's accounts receivable. Service revenue is a revenue account, and it's increasing because we provided services. Accounts receivable is an asset, and that is also increasing because we have the right to collect that money, right? We're just waiting for our customers to pay us. And so to increase a revenue is a credit, and to increase an asset is a debit. And so our journal entry would be a debit to accounts receivable for $1,500 and a credit to service revenue for $1,500. Now we're going to collect $800 from customers for services that were previously provided. So we've already provided the service, which means we already recorded the revenue, so we can't record revenue again. Okay, so we need to record the cash that's coming in, and then we need to show that they previously owed us money, and now we need to reduce that accounts receivable. So our two accounts are cash and accounts receivable. Our asset of cash is increasing, while our asset of accounts receivable is decreasing. So we increase our asset of cash with a debit, we decrease our asset of accounts receivable with a credit, and our journal entry then is a debit to cash for $800, a credit to accounts receivable for $800. So in summary, we've gone through now a few typical situations that you'll find in a company, and you note that we did a separate journal entry for each activity that occurred in the company. And for each journal entry, we showed the debits on the top, the credits on the bottom, making sure that our dollar values of our debits and credits were always equal.